So the RBA have just met and they've announced what they're going to do with rates. Hey guys, coming in fresh, just a couple of hours after the RBA decision. You can always rely on me to jump on here as soon as this stuff breaks, because if you are a nervous home buyer or a stressed homeowner, you cannot afford to be the last one to find out. So here's the news. The RBA has held the cash rate at 3.6%. Now, this was a unanimous decision, so you may not know this, but there's a board and they all have an individual vote, okay? The majority rules, that's how it works. In this case, the whole board agreed to hold rates where they are. The biggest takeout from this announcement is that a rate hike is on the table for 2026. The Governor Bullock couldn't have been any more clear. They're back on the table, rate hikes. Now, on top of that, two of Australia's biggest banks have just flipped their forecast. They're no longer talking about more cuts. They're telling you to get used to higher rates for longer. And Michelle Bullock has made a pretty shocking admission about inflation that is going to make a lot of current and future borrowers very nervous. So let me walk you through what the RBA decided today, what Bullock actually said, how the big banks are changing their stories, and what this all means for your mortgage and buying plans in 2026. And of course, what investors need to think about for the future. So let's actually get into it. So let's take a look what the RBA has actually said in their statement, and importantly also what they did not say. Now, officially, the cash rate stays at 3.6%. This is the third hold in a row. This is the final meeting for 2025. Now, the statement sounds calm until you translate it and you start to look a little bit deeper and read between the lines. The RBA does say inflation has fallen substantially since its peak, but it has picked up more recently. The translation there is inflation is moving the wrong way again. It's headed the wrong direction. Headline inflation is about 3.8%. The trimmed mean is around 3.3%. Both are above their 2 to 3% target band. But what's important is where it's headed, it is moving up. Now, they also say the risks to inflation have tilted to the upside. That is the central bank code for we're now more worried about inflation going up than down. So don't expect more cuts. At the same time, the economy is still growing at around 2.1%, which is actually very strong growth for a developed country. Now, unemployment is only 4.3%. That's actually very healthy and in a good spot. Private demand is recovering. So from their point of view, the economy is too strong right now to justify more easing. Today was not rates on hold and cuts coming. Today was rates on hold and potentially brace for a rate increase. Now, big banks are also adjusting their forecasts. This is the part that really matters for your mortgage. Two of the biggest banks in the country have basically come out and said, we're done with cuts, that's it. First of all, let's take a look at Commonwealth Bank. Now, CBA is Australia's biggest home lender. Most Aussies watching this have had a loan with them or have a loan with them today. Now, the CBA economists are now saying we're at the bottom of this cycle, which means no more rate cuts, guys. There's only one way from here, they're up. They do not expect any more cuts in this easing cycle. The cash rate is likely to sit at 3.6% for an extended period of time. If inflation keeps surprising on the upside, the RBA might even need an insurance hike to push it back, maybe 25 basis points up. That may actually happen. That'll be the worst thing they want to do. They really don't want to do that, but it is definitely not off the table. So CBA's base case is get used to this level. It's not going away quickly. Let's take a look at what ANZ have said. ANZ came out and basically backed what the CBA is saying. They're right in line there. So they were the last major bank still penciling in one more cut in early 2026. They've now scrapped that. They say the cash rate will be at 3.6% right through 2026. And again, if inflation misbehaves, the next move could be up, not down. Let's take a look at NAB and Westpac. Now, NAB is in the same camp as CBA and ANZ. No more cuts. They believe there's going to be a long hold at 3.6%. Westpac is still clinging to 2 cuts in 2026. But they are now the outlier, not the norm. So the story has flipped. At the start of the year, everyone was talking about how low will rates go. Now, 3 or 4 majors are effectively saying this is the floor and we might have to go back up if inflation doesn't get under control. This is a massive sentiment shift. So specifically for investors, what does this mean for you in 2026? Let's talk about what this actually means for your next 12 months. So first of all, let's take a look at mortgage holders. You need to stop planning your life around rate cuts. They're not coming. Inflation is sticky, unemployment is low, and the RBA is openly talking about upside risk. the base case now is no more cuts this cycle. The cash rate will be at 3.6% for a very long period of time. There's a real risk of a rate hike if the next CPI number comes in higher than what people expect. And yes, guys, 3.6% is now the new normal. It feels high, but historically, it actually is a very low interest rate. If your plan was, I'll just hang on until rates drop, that plan is gone. Banks now are forecasting higher rates for a longer period of time. CBA's flipped, ANZ has flipped. Both now say 0 cuts in 2026. Term deposits are rising because markets think we've already hit the bottom. Higher for longer isn't a theory anymore. This is now official bank policy, and we're seeing it in home loans, we're seeing it in fixed mortgage rates, and we're also seeing it in term deposit rates. Now, if you're a first home buyer, someone looking to upgrade, or an investor and you're wondering about house prices, okay, properties are not suddenly going to become cheap from here. We're not going to see a crash in the market. In fact, we're not even going to see the property cool. It is not going to happen. I want to take you back to recent history where we saw rates go from basically 0. We had 12 rate cuts in a row. And literally during that massive rate hike cycle, we saw record house price growth. You see, interest rates are not the be all and end all in terms of property prices. The main fundamental is going to be supply and demand. And supply and demand right now is supporting continued house price growth. The property market isn't suddenly going to crash or fall backwards, okay? Yes, rates may stay higher for longer than forecasted, but this will not set the property market back. Now, the old rule, rates up, prices down, that's completely broke. Why? Because the fundamentals were too strong. Supply was just too low and continues to be too low. Demand was too high and continues to be high. And today, those fundamentals are actually worse. We've already missed year 1 of the National Housing Accord. The shortage is stacking up. New builds are delayed. Migration is strong. Population growth is strong. Rents are continuing to grow. And on top of that, we have 2 demand bombs going off at the same time. These are from the federal government. Firstly, the 5% deposit scheme is live. And we've also got the shared equity help to buy scheme, which is just launched. So together, these 2 policies are about to unleash more demand into an already unaffordable market. So we now have more forces pushing prices up than pulling them down. So even if the RBA were to hike rates 25 basis points, that is practically nothing. So you absolutely do not want to be waiting for a property market crash. The only way the market crash is if we suddenly have 0 population growth, or if we suddenly have hundreds of thousands of new properties hit the market in a short space of time, none of which are going to happen in the next 5 to 7 years. So what you need to be doing right now is assume that the market is pretty much set at 3.6%. That's your baseline in terms of your forecasting. Shop around and fight your lender for a better deal in terms of your mortgage, and don't sit out of the market waiting for cheaper prices. That window is never going to come. It isn't here. We're going to see continued month-on-month property price growth. So every month you wait, housing is going to get harder, not easier. So guys, I want to hear from you. What do you think happens next? Do you see the RBA hiking in 2026? And if they do you genuinely believe the property market crashes? Or does it just keep marching higher because the fundamentals are still completely broken? Drop your thoughts in the comments below. I do generally read all of your comments. This was your daily property update, your 3 to 6 minute breakdown of what's really happening in the market so you can become a property insider. Make sure to hit like and hit subscribe so you never miss a video. And tomorrow I'm going to do a much deeper dive on interest rates and what's going to happen in the market over the next 3, 6, and 9 months. There really is an incredible opportunity for property insiders and property investors in that very short window.